second quarter earnings being quite strong. We don't see them being as strong as first quarter earnings. First quarter earnings were up 14%, and prior to that we had an earnings recession. But the average, according to Thomson Reuters, is 6.5% earnings growth. But we feel that could easily be 8 or 9%. There's easy comps, there's a growing economy. We think that we could easily be up in the high single digits.
Can you elaborate on that?
As far as valuations, we feel like that we're very fully priced in the equities market, but we do see a lot of rotation in and out of sectors, which is one reason why even on bad news we don't see the S&P or the major indices going down. We see a sector rotation within the index, and so what seems to be on the outside a somewhat flat or slightly grinding ahead indices, underneath there's a lot of sector rotation.
Would you like to say something more about valuation?
So as far as going into the year end, one of the questions that people, investors ask a lot is the Trump bump, the Trump plan. We don't believe that the markets have any more into the financial markets based off of any of the Trump agenda. So the tax reform, tax cuts, healthcare, or the infrastructure spend, all of those are risks to the upside. If any of those do have to, if any of those, the news comes out that those will happen, then we feel that there'll be a nice bump to the upside in addition to what we already have based off of just earnings. So currently, the news that came out yesterday about the Trump care or the repeal of Obamacare is going to have its effect, as that's going to affect the healthcare industry. But in general, no investment managers, we believe, have baked into their forecast for 2017 any of the Trump plan or Trump agenda. So if any of those do come to pass, there will be a nice bump to earnings and to the markets. The U.S. 10-year yield is really almost exclusively based off of the European market right now. So the ECB is going to make an announcement tomorrow morning. We feel that the 10-year is artificially depressed due to large institutional buyers from overseas and the search for yield. So even though the 10-year is very low, 227 I believe this morning, that does not represent the natural value that the 10-year would be at if the European bond markets were pricing in higher yields. So to the extent that the German Bund was to decline in the near future, that would have a big effect on the U.S. 10-year, which would provide steepening for the curve and growth to the economy and obviously a big lift to financials. But we feel right now that until the European interest rates start rising, the 10-year is going to stay artificially depressed. But we also feel that that's good for the U.S. markets, especially in an environment where Janet Yellen says that she is very dovish and she doesn't want to raise interest rates too quickly. And to the extent that it provides lower cost of capital for all the American corporates, we feel that that's a tailwind for U.S. earnings and U.S. growth in 2017.